Nike just reported a 12% sales decline in China. Wall Street barely flinched. Earnings beat, revenue beat, stock dipped, analysts shrugged, and that reaction right there is exactly the problem. Because the number that should have every global investor paying attention is not the earnings beat, it is that 12%. China is not a side market for Nike. It is one of the most critical growth engines for the entire consumer discretionary sector. And when sales fall that sharply in a single quarter, that is not a turnaround story. That is a signal. Let me explain why this matters far beyond one stock. Nike's CEO, Elliott Hill, has been on a turnaround mission since taking the role. He has restructured, he has cut costs, he has tried to pull Nike back from over-reliance on wholesale channels. And this quarter, by most headline measures, it worked. Earnings beat expectations, revenue held up globally, but analysts on Wall Street are not buying it. UBS reiterated a neutral rating and cut the price target. Analyst Jay Soul was direct. He said Nike's stock still is not cheap at around 27 times forward earnings. He said a solid rebound is still priced in despite the China weakness. Think about what that means. Even after a 12% China sales drop, the market still expects recovery. That optimism is the risk. Here's the contrarian case most financial media is not making. Nike's China problem did not start this quarter. Chinese consumers have been pulling back from Western brands for over 2 years. Domestic Chinese brands like Anta and Li Ning have been eating into Nike's market share, not through price, through identity. Chinese consumers increasingly prefer brands that feel culturally theirs. That shift is structural. It is not a bad quarter. And here is where it gets interesting for your broader portfolio. Nike is not alone in facing this. Think about every major Western consumer brand exposed to China. Luxury goods, cosmetics, sportswear, fast food, technology hardware. All of them have been watching Chinese domestic preference shift quietly for years. Nike's 12% drop just put a number on something that has been building slowly, and the market is still treating it like a company execution problem. It is not, or at least not entirely. The Chinese consumer economy is behaving differently now. Youth unemployment in China hit historic highs last year. Consumer confidence surveys have been weak for months. Domestic spending patterns shifted toward local brands and value options. None of that changes because Nike hires a new CEO or restructures its wholesale network. Now hold that thought for a moment, because this is where it connects directly to your portfolio. Edward Jones published a research note this week recommending investors stay overweight emerging markets. The argument is strong earnings growth and AI exposure, and that argument has real merit in certain regions. But emerging markets is not one homogeneous trade. China is the largest single weight in most emerging market index funds. If you own an emerging markets ETF, and millions of everyday investors do, you have significant China consumer exposure. You are, in part, betting that Chinese consumer spending recovers. Nike's numbers this week suggest that recovery is not happening on the timeline most funds have priced in. If you are finding this useful, consider subscribing for more practical financial insights. Let me give you a real example of how this plays out. Imagine you have a diversified portfolio. You own an S&P 500 index fund, a global ETF, and an emerging markets fund. That feels diversified, and in many ways it is. But buried inside all three of those funds are companies with heavy China revenue exposure. Apple derives a significant portion of revenue from China. Several major luxury brands and global ETFs depend on Chinese consumer demand. Emerging market funds are often 25 to 35% weighted toward China. So when Nike's China numbers come in at negative 12%, the question is not just about Nike. The question is how many other companies in your portfolio are quietly carrying the same exposure, and how many of them have the same optimistic recovery story priced in. Now let me be fair here. China's economy is enormous and complex. It does not move in one direction forever. There are genuine policy levers the Chinese government can pull to stimulate consumption. Interest rate cuts, property market support, consumer voucher programs. Several of these have been deployed in the last 12 months. And in specific sectors, particularly technology and AI infrastructure, Chinese companies are thriving. The broader market has rewarded that. But the consumer side of China's economy is a different story. And Nike's results this week are one of the clearest data points we have seen confirming that divide. Here is what most analysts are getting wrong about this moment. They are treating China consumer weakness as a cyclical problem. Cyclical means it comes back with the next growth cycle. But structural problems do not work that way. A generation of Chinese consumers choosing domestic brands over Western ones is a behavioral shift. It does not reverse because Nike launches a new shoe or runs a new campaign. It reverses when the cultural identity calculus changes, and that calculus does not change on a quarterly earnings schedule. This is the part of the Nike story that Wall Street glosses over. The turnaround plan can be perfectly executed and still fall short in China, not because Elliott Hill is doing the wrong things, but because the structural headwind he is running into in that market is not fully within any CEO's control. So what does this mean practically for your portfolio decisions right now? First, audit your China consumer exposure across your funds, not just emerging market funds. Look inside global equity ETFs too. Many investors are surprised to find how concentrated that exposure actually is. Second, understand the difference between China tech and China consumer. These are two very different economic stories right now. China's AI and technology build-out is accelerating. China's consumer discretionary spending recovery is stalling. Treating China as one trade is where most everyday investors make the mistake. Third, be careful about stocks trading at high earnings multiples with China turnaround stories priced in. Nike at 27 times forward earnings needs a strong recovery to justify that price. If the structural shift in Chinese consumer preference is real, that recovery timeline extends, and extended timelines in high multiple stocks are expensive to wait out. None of this means Nike is a bad company. It has extraordinary brand power globally. Its North America and European numbers have actually been improving. The turnaround story outside China has real traction. But one market representing 12% decline on top of pre-existing challenges is not a small detail. It is the variable that determines whether the entire bull case holds. And right now, the market is still paying a premium price for a recovery that the actual sales data does not yet support. This is one of those moments where the headline and the story underneath. The headline says, Nike beat earnings. The story underneath says China's consumer recovery is slower and more structurally complicated than most portfolios are built for. What you do with that information is up to you.